ladies and gentlemen, and Thorney Opportunity shareholders, and welcome to our first briefing post the half-year results. And I hope everyone is well and safe through the ongoing COVID pandemic. And let me just talk about those results. We had a pretty solid 6 months of the year, with the June 2020 NTA after fees and taxes at 61 cents, and by the end of December, 6 months later, standing at 6 cents. That is about a 15.7% uplift in NTA for that period. So at the same time, we did declare a 10% increase in the dividend for that period to 0.8 of a cent. As I said, up about 10%. So with the share price as it is, we're currently trading on about a 3.5% odd percent dividend. Continue to grow dividends and to increase that return for shareholders through the dividend, as well as ultimately growing through the performance of the shares. During that period, we saw, and even in the last few days since the beginning of this year, the start of what we see as a bit of a rotation happening out of the high growth tech sector, and indeed NASDAQ was down again last night, into area of value investing and responding to sort of turnaround and repositioning of companies, perhaps in a more traditional kind of investment framework. So that has been, to some degree, a long time coming, and value investors have suffered over the last few years as we've seen this massive outperformance by tech companies, some justified, some perhaps not. But in any event, we think that the nature of the companies in the Thorney Opportunities portfolio have the potential to perform well now into this period of readjustment of investment direction. So, as I said, we're up 15.7% for the half year, and we're looking forward to 2021 as some of our investee companies, particularly those that we've been with for a while, come to fruition, and we get rewarded for some of the time that we've spent on it, indeed. So this morning I'll say a few more introductory words, and then we have two great companies presenting, both of whom have been part of the investment portfolio for Thorney Opportunities for a while, and indeed also within the private Thorney Group, where we often align investments. So we'll be hearing from Scott Baldwin from Money3, and then also from AMA, Carl Bison, the recently appointed CEO. But just before that, let me make a few further comments. We get a lot of questions about why the company is trading at a discount to its NTA, and that's something we've addressed and talked about a couple of times over the year, and it's doggedly persisted, the underlying discount. So, as I said, one of the reasons I think is that value and turnaround kind of style value add work that we've done on our investee companies has not been the popular sector to invest in over the last couple of years, but it is something that we believe we have a lot of strength in, and that at some point in time value does emerge, and we think that point in time is starting now. And also generally the LIC sector has been trading for the most part at discounts over the last couple of years, but we will persist, and we've got a number of initiatives to look at as to how to bridge that. And again, I would remind shareholders that I'm the largest shareholder myself in TOP, so it's I'm trying my hardest to perform there so that I can get the performance myself and the return on my investment in Thorney Opportunities. First of all, we've announced that we're going to continue with the buyback, and we've started nibbling away on that, and we will continue whilst the discount is obvious and apparent, and whilst we have cash that can afford to do that versus other new investments. Secondly, and I'll come to it in a little bit more detail towards the end, we had our first experience about 12 or 15 months ago investing in a non-publicly listed investment opportunity, which we've had a lot of experience again in the private Thorney investment company over the years, but it was a new position for TOP, which has previously just had listed opportunities. So that was in the investment in ACM, the media group that we bought from the Fairfax 9 group, as I said, in June or July of 2019, in partnership with former executive of Domain and Fairfax, Anthony Catalano. So I'll talk about ACM a little bit later, but suffice to say that it was a challenge that we took on, and we've had COVID to deal with there, bushfires, droughts, but we've come through that very well. And in fact, we've revalued the assets upwards with support of the directors after having at the mid-year taken at the end of last year, June, taking a prudent approach, just given how the world was looking. So our rationalization, our restructuring, our efforts in that are proving to be quite exciting, quite lucrative potentially. And we see ourselves having the skills to do more of these private deals and bringing the value out. And ultimately, they may lead to an IPO or other form of realization of that business, but also it could be a source of cash flow, which will increase the dividends for shareholders going forward. So very briefly, again, within the listed portfolio, we've had some mixed results over the period. Money3, which we'll hear about, is performing very well and is a good dividend payer. A couple of companies in the portfolio have gone through some challenges during COVID and some executive leadership challenges. One of the disappointments in the portfolio for a couple of years now has been Pala Pharmaceuticals, Pala Pharma, which we think has still got great potential. That is in the sort of legalized opium market for pain management. It's a lot of capital has been spent on the journey, but now we think they have a fully integrated model from growing or sourcing growing to processing straw, to powder, to tablets in this highly regulated and licensed environment. Trouble has been that they have had to change their leadership. They have a new leadership group now, with the CEO having left recently. Arguably, I think the board should have moved much quicker over the years to have changed and to professionalize the leadership more for the challenges of being in international markets. But finally, that's happened, and we're looking forward to following a recapitalization in the last few days, of which we participated in, because having gone on this journey so far, we don't think it's worthwhile giving up right at the end, whilst we still think the potential is there. So big disappointment for us. Obviously, we've made a mistake in the timing of our investment there, but I think hopefully that that will show some signs of going up. But look, before I talk further about some of the other individual investments, we have Scott on the line from Money3, and Money3 is, and Scott's been at the helm of that company for quite a number of years. He's done a terrific job, but not only in growing the business in Australia, but also in expanding the business into New Zealand, changing the nature of the business to be very directly and purely focused on the auto finance market. I think that the loan book is growing swiftly, and I think he has aspirations to expand that further. Scott, are you there? Can you hear me, Scott?
Yes, I can, Alex.
Oh, great. Well, thanks for joining us today, and I just want to congratulate you on the performance of the company under your leadership. And I know you're moving to a more automated process all the time, and using technology to make the product more efficient and the service to customers more efficient and more reliable. And I might just hand over to you, Scott, just to tell us briefly what Money3 does and why you're succeeding in growing the loan book so effectively.
No, thank you, Alex, and appreciate the invitation to speak to investors this morning. For those of you that are not familiar with the Money3 story, we're an automotive finance company, focused on all types of vehicles and funding those in essentially the non-bank sector. Now, we have presences in New Zealand and we trade there under the brand name Go Car Finance. And in Australia, we have two businesses, sort of two different products in what we would call that subprime non-conforming car loan and mid-prime, which is sort of just below bank car loans, called automotive financial services. Both of those, between both countries, we think that the market opportunity is about $40 billion. So it's quite a large opportunity if you look at all types of vehicles and trucks and other things. And our business receives applications for those loans from broker networks throughout Australia and principally directly from dealer groups in New Zealand. The business also has a lot of strength in direct to customers because we've got over 500,000 customers. We do a lot of internal marketing, trying to avoid things like Google to get our customers to come back and apply to us directly. That's the business in a nutshell.
Yeah, and Scott, there's been challenges through COVID for all businesses. How have you managed during that period? And how do you see the landscape at the moment going forward for the sector that you're in?
COVID's been a bit of a roller coaster. It's been very interesting. Our cash has been exceptionally strong off the back of government stimulus in both countries, but it's really driven by consumer sentiment. People want to make sure that their car loans are up to date. They are telling us every day that they really value their car, the desire to avoid public transport and the desire to have access to a vehicle has meant that we've had very strong cash flows through this period with customers choosing to get ahead of their car loan payments. And investors can see that with our improving bad debt position and improving provisions. So that from that regard, it's been quite strong. In terms of access to vehicles, well, that's been a bit of a challenge, particularly in Australia, where with lockdowns and with limited new cars coming into the country, we've just seen a bit of a subdued used car sales process. The very encouraging thing has been coming into February and then through to today, we've seen growing applications from customers and we've seen strong demand for that. And we sort of expect through the course of this year that as new cars start to import into Australia, that we'll start to see a strong pickup in actual settlements and loan book growth for the business. New Zealand, slightly different dynamics, given that they import their used cars from Japan, and that process has really started to recover now. So starting to see used car prices come down a little bit in New Zealand and strong demand coming back. So, in terms of our growth as a business, New Zealand's going to deliver quite a bit of growth for our business over the next 12 months, we think. And then as confidence returns, particularly in the Victorian market, we're confident of seeing that 20% plus growth in new vehicle originations start to come through.
Yeah. Okay. And I mean, there's always a risk when you expand in geographies. So just a bit more on New Zealand and what it took to go over there, and how is that looking going forward?
New Zealand's been a really good acquisition for the business. There's been a strong cultural fit between the two businesses, and I think that has been key. The founders of that business and the executive team at Money3 share a lot of similar values about how we treat customers, and it's made that transition fairly seamless. We've seen some really good technology in New Zealand that we hope over time we can start and transport some of that over to Australia. But that acquisition, when we acquired the business, had a loan book of about $50 million. As of last month, it's now exceeded $135 million. So it's more than doubled and well on track to sort of, by the end of this financial year, be close to $150 million and probably making a 20% contribution. What we learned through that acquisition... Yeah, we learned a
Yeah,
lot
that's
through that.
terrific. That sort of growth in that short period of time. So congratulations on that one. Now, Scott, you might spend a minute just talking about how you finance your business. I remember in the early days there was a lot of equity, and then that and some banks. The banks sort of changed their policies, and you have to get some overseas funding. And now it looks like the whole sector is maturing a lot more, which I think gives you more opportunities to scale up, but more effectively in terms of cost. Is that right?
That's very accurate. We shortly will have 4 banks providing funding to the group as a whole. So we not only have banks backing us, but several banks. So that's been a really strong endorsement of the business model that we now have, and will allow us to improve the leverage of the business, which for shareholders will they should expect to see a continual improvement in the return on equity in the business, and hence growing earnings per share as well. So that bank support from Westpac and Credit Suisse in particular, and not to mention BNZ and Heartland in New Zealand, has been very well appreciated by the business, and will help us drive that leverage, because we're still as you mentioned, the equity component. At the end of this year, we're going to move a little bit above 50% of our book being debt, and the end of 22 is our prediction. So we still have a lot of opportunity to grow that leverage and continue to improve that return on equity. We think moving closer to that 20%.
Right. Okay, and that's a fantastic transition. I guess shows the maturation of the market, but also a reflection of your metrics in terms of, there was concerns about overwhelming bad debts at one point in time and things like that, and none of that has proven to be the case. In fact, your metrics keep improving while you're scaling up the business and growing the business constantly. One of the ways you've improved the experience for customers, and I guess your own internal efficiencies, is through automation and some technology. Can you just give us an update on what you've achieved and what's still to go in that regard?
Yeah, we have put quite a lot of money into investing into the technology that allows a customer to apply for a loan online, whether it be directly through a website or through a broker or a car yard, and have that take out the manual re-entry of a loan application, and have that flow straight into our credit engine, and start knocking out those customers that don't meet our criteria, that essentially trying to disconnect that need to add more headcount as we process more loans. We would get close to 10,000 applications a month now, and that technology is allowing us to churn through that without having to exponentially grow our workforce. So that's been a big part of the focus, as well as the marketing engine that allows us to use algorithms to pull out the customers that we think now is the right time to put an offer in front of them for a new car loans. Things like coming close to the end of term of loan, or when they might have an insurance renewal, just having something from the group in front of the customer at that point in time to remind them of the relationship that they have, so that they don't think about applying for a loan with a competitor.
Right. One would think that customers have plenty of choices as to where to go. Why will they come to Money3, and why are you confident of continuing to grow your market share and your loan book?
We get the feedback from many of our introduction partners that we're one of the fastest to give an answer as to whether whether we're happy to lend to them, and that speed allows the customer to get access to the car quicker. And then I would say, after they've acquired their car, we've spent a lot of time and the investment in our large customer care team that do all of the collections, and the ability for them to speak to the customers. What we think that investment is what gets people to stay. We're approaching 1 on 3 customers now coming back to us, having had a car in the past, and now applying for a new loan, having had a loan in that past. And that stickiness is very key to the profitability, because you're not paying to acquire the customer a second time. So I certainly would say there's two things: that the speed of the response in getting back to the customer, and that digital experience. I mean, essentially, to apply for a car loan with the group, there's no paper required anymore. It's fairly seamless. We're trying to get to a point where you don't need to leave your mobile phone to apply for a loan, sign up for the loan, and settle it. And then once the loan settles, whether it's human interaction or phone calls, what I mean, or text messages or emails, keeping that conversation with the customer through the journey. So when they come to getting their next new car or other asset that they want to buy, that they think of us first, and it's quite seamless to click a link and apply for a loan. I think they're our two keys.
Okay, and you've got an environment where people, as you said, I think earlier on, are seemingly avoiding public transport. So, you just have to go into the city to see that, and you just drive on the roads and you see the traffic is up considerably. But I think while that trend continues, that's probably a strength, an opportunity for the group. Would that be the case?
I think that's the case. We're hearing that in terms of feedback from people, that it's not just the avoiding, it's the fact that you can't go overseas. So, one of the growth areas for us, so that if you think of those camp trailers that pop up, people are buying them in greater demand than we've seen in the past. And, they're saying they're thinking of a local camping holiday, and, they're buying those assets to, rather than flying to Bali or other locations. So we're seeing some of that money divert to buying an asset rather than a traditional holiday, because you can't leave. Often for Victorians, you can't leave the state, but for others, you can't leave the country. So I think that's also a tailwind for the business.
Yeah, that's a huge thematic that I think, yes, you can take advantage of it. And probably our next speaker will talk about that as well. But anyway, Scott, I wanted to thank you for joining us today. You have joined us in the past, and we've followed the journey of Money3 now for many years, and it remains the largest position within the Thorney Opportunities portfolio. It's a good dividend generator for us as well. But in terms of upside, we're happy to see that most of the investment broker analyst reports since your results have been positive for the outlook, and with upside valuation from the current share price. So we hope that comes through to fruition. But I wanted to congratulate your board and yourself for the performance through this pandemic year of last year, and really steering the company to probably the best shape it's ever been in, and having taken it, as I said, overseas to New Zealand, and having a fantastic result there and growth profile. So we're looking forward to seeing some very good metrics, and we're looking forward to the brand of Money3 becoming even better known. And again, thank you very much for joining us this morning.
No, thanks for your time, Alex. I'm very confident that 22 will be the best year we've ever delivered, and we've set the foundation for that in 21 with the changes and the acquisitions. So I think investors should be pleased to see solid growth coming into 22. And thanks again for your time.
Yeah, thanks a lot, Scott. And I suppose on the car theme, we'll continue with another company that's obviously involved in the automotive space, which is AMA. And Carl, are you there?
Hi, Alex.
Hi, Carl. And Carl Bison, ladies and gentlemen, who's the recently appointed CEO. But AMA, for those, probably those who have followed Thorney Opportunities for a while, would know that we've been involved with AMA in one form or another for a little bit. We were a largest shareholder at various times, and more recently we've been adding to our position. AMA is the, well, actually I won't describe it, but it's in too much detail. I'll let Carl do that. But Carl, just briefly, for those who don't know AMA well, just first of all, what does AMA do, and why, and welcome to the CEO role.
Thank you, Alex. AMA is Australia's largest panel repair or collision repair business. So we hold a substantial position in the panel and collision repair business in Australia and New Zealand. The industry is around 7 billion in size. we will be somewhere between 900 and $1 billion of that in the coming period. I suppose the core thesis of AMA's position in the marketplace is the typical roll-up or aggregator strategy that has played out well in a number of different markets around the world. We currently have 180, 181 odd sites, panel repair sites around the country. Our nearest competitor would be somewhere around 10. So the substantial scale and volume that we give the insurance industry in Australia is something that we believe we can extract significant leverage and significant value out of for the shareholders of the company.
Right, and we'll come to that in a minute in terms of the synergies across being the largest operator. But just to get the most topical part of the discussion over the papers over the last few weeks, I just wanted to point out to shareholders that Carl, in fact, has been a successful CEO in a number of locations before he took on this role, including at a company that many of you would know, which would be Jayco Corporation. But he has been on the board, I think, for 12 or 18 months, Carl, before stepping into the CEO role. And how easy a transition was that from Jayco and other functions to just being a director and now back in the CEO hotspot?
It has been interesting, Alex. In fact, my role immediately prior to coming to AMA, I was the global CEO of a US listed company called Horizon Corporation. So I actually left that company in around 2016. I was responsible for their operations for the rest of the world, based here in Melbourne. I had facilities in Australia, New Zealand, Thailand, China, South Africa, Germany, Finland, and the UK. I left them to work in the RV industry with Jayco Corporation. After doing that for a couple of years, I actually got asked or approached to go back to the Americans. So I packed up my life and moved to the US to run their North American operations. And 3 months into that assignment, the board decided to make a change of the CEO, and I was appointed global CEO. So that was a circa $1 billion US listed company that I ran for a couple of years prior to returning back to Australia over the Christmas of 18. So it was in my time at Horizon Global that I was introduced to AMA through a process to divest part of the company at that time. So I joined the board immediately upon returning to Australia and have been on the board for a year. And then obviously, if anyone who's read the Australian or the Fin will realise that there's been a necessary change of CEO at AMA. I suppose I had the benefit of being on the board for a year, and to your point, I pretty much knew what I was getting into. Obviously, it's different being on the board to running the company. However, I think it was time for the company to pass the baton on to the next evolution of leadership for the company as it approaches $1 billion Australian in turnover and becomes a substantial Australian listed company with all the requirements of governance and systems and processes and controls that you would expect for an organisation of that scale. So fortunately for me, the board knew me well. I get on well with the chairman. I think in any CEO's role, getting on well with the board and the chairman is quite critical. They certainly were able to interview me for a year, I guess, in some way or form. So I was honoured to be given the opportunity. I'm very clear about the future of the company and how to extract value out of its operations for the benefits of the staff and the shareholders.
No, that's terrific, Carl. And I mean, the history of the company has been of recent times a series of acquisitions and growing through both greenfield sites, but through those acquisitions and I guess professionalizing what has been a cottage industry for many years. And
right.
AMA has emerged as the largest player in the Australian market, and we've seen that trend a little bit overseas. In doing so, of course, took on some debt at various times, and you've got debt to manage. With the largest acquisition that happened to the company, I think within the last couple of years, making you the clear leader. More recently, the company has divested one arm of the business, and the proceeds of that, I think, going to reduce the debt. How
Correct.
comfortable are you with the strategy of acquisitions? What is the greenfield opportunities, and how comfortable are you with the debt that's still within the group?
Well, Alex, I think the acquisition of the Capital Smart business and associated ACM parts business from Suncorp, just over a year ago, has certainly given AMA scale. And I think the position that I had with the board when I joined the company was really to understand what our core strategy was. And I think a lot of companies can get lost in terms of having too broad a strategy that's too hard to understand for investors. And my view, which was shared by the board, was it was necessary to simplify the business and really understand what investors saw. And the investors saw a pure play panel business that was a roll-up strategy that had proven to create value in a number of different markets around the world. And it was on that basis that we decided to seek expressions of interest for the divestment of the ACAD businesses, which we did. That business successfully transitioned, or those group of businesses successfully transitioned to GUD on the 31st of December last year. The proceeds of that, the circa $70 million, was obviously applied to reducing our debt. Our gearing levels are sort of low to mid twos over the journey, I think, are somewhat appropriate for where we are. I don't see on our horizon any need for a substantial raising of debt or equity to fund a similar scale acquisition as Capital Smart. Capital Smart, as you know, was a circa $400 million acquisition. That certainly gave us undeniable scale in the industry. The industry is characterised by thousands of privately owned, generally undercapitalised panel repair shops. The insurers have a large deck of suppliers to manage in terms of those panel shops. There is enormous value for us to take our scale and our value to the insurers and leverage extraordinary value from that as being a substantial scale advantage over our competitors. So I think from here on in, acquisitions will be regular and small and will be quite strategic. They will be focused on either capacity, where we have a capacity need with a particular insurer in a particular market. They will be greenfields if there is a particular geographic area where we believe we need to install some capacity, where there is no logical acquisition or right price acquisition for us to pursue. Or thirdly, we'll be expanding elements of our business where we believe it's margin accretive. And recently that's been in the truck and bus, the heavy repair industry, where we've recently made a couple of acquisitions last year and one in February of this year. We see EBITDA margins in the heavy side of the business being circa double what we see in the rapid panel repair business. So as we go forward, I'll be looking at different acquisition theses for the business as we continue to grow. At the moment, we're less than 15% market share of a $7 billion industry. There is substantial runway for us for further consolidation, right price consolidation, as we continue to expand and leverage our scale in the industry. And to give you an example, typical panel shops, we're buying at somewhere between 3 and 4 or 5 times earnings, depending on their margin profile. And if we can get our shares trading at a multiple of that, I think we're doing pretty well. And it's a sensible use of shareholders' funds to continue to grow the business and leverage our scale in an industry that will always need to be. And I think that's one thing that I'll often talk to investors about, that this is an industry that is somewhat boring. It is going to be around for a long period of time. Strategic growth with a good management team that understands how to run the business effectively and efficiently and deliver good returns for shareholders is an undeniable long-term value proposition for any investor, in my view.
Yeah, well, I agree. And I was very happy to see you divest that business and become more single focused, as you say, and more of a specialist in the area where you're large. I mean, I'm definitely encouraging of buying those smaller acquisitions as add-ons, and I think that just adds to your scale and your efficiency. I think perhaps you might explain to people a little bit, Carl, if you wouldn't mind, the sort of the benefits of synergy across things like paint and whatever. As your scale gets bigger, your buying power gets better, I suppose. And that really, you didn't have a chance to exploit all of that during COVID when the borders were shut. But it looks like hopefully we're on the period where borders are opening up, and you can, in fact, get the benefits of some of the synergies across the whole country now for the group. Is that how you see things during the course of this year?
Absolutely. And to give you some numbers to help sharpen people's thinking around what scale means in our business, a typical panel shop would turn over $2, $3, $4 million turnover, $2, $3, or $4 million. So you might find some multi-site operators that may have 2 or 3 sometimes, and there's a couple that might have 8, 9, or 10. At 181 odd sites that we have, our parts purchase alone is circa $350 million is what we buy in parts from the industry. So the substantial scale that we give the automotive companies in terms of volume and reliability of parts consumption gives us buying power that is unmatched to any of our competitors. You also think about paint, which is another one of our key ingredient costs. We're spending circa $40 million a year on paint. There are companies that don't do that in turnover, let alone acquire that in paint. So our relationship with our key paint supplier, BASF, is long-term and mutually beneficial. We have a very partnership-based approach with that supplier. We've entered into a long-term supply agreement where we receive substantial rebates for the volumes that we purchase, and in return, they provide us with a rebate in advance, which we call a prebate, that we actually use to fund some of the acquisitions of the business and also to reduce our cost of paint. The third and final benefit we have is, as a substantial business of our scale, all our consumables that we use in the production process of repairing motor vehicles, we direct source from low-cost countries. We are not buying from a local wholesaler around the corner. So our scale has enabled us to eliminate that margin between a manufacturer and a panel shop that every other supplier or every other peer that we have in the industry has to tolerate. So effectively, if you think about the rebate we get off BASF, it's a benefit for volume, but also a passing on of that margin that they have to give to the distribution network that they can give directly to us. So we give them volume, scale, and leverage for themselves. They lock up an enormous amount of paint volume, automotive paint volume, in a country that no longer produces motor vehicles. We have scale to be able to go to direct to factories that produce abrasives, tapes, and all the production items that we use, and buy those directly, warehouse them in China and bring them in and distribute them through our panel shops. And thirdly, we have enormous benefit in terms of our buying volume with all of our motor car suppliers for parts. And in some cases, through our own recycling and parts sourcing business, ACM, we're able to either parallel import or to secure aftermarket parts at a price that other panel shops have to buy through distribution. So we're uniquely positioned to be able to expand our margins and create leverage with those benefits.
Yeah, I think that's really the exciting part about the growth, and in addition, getting the valuation arbitrage of buying smaller panel shops relative to your own where we're trading is a great uplift and justified by what you can bring to those shops as you bring them into the fold, and then within a proper governance culture and operating culture. So, and I'd remind shareholders that before the company had the scale that it's got now, with all the benefits Carl talked about, it was actually trading at a much higher price than it is today. That's say 2 years ago or something like that. I think the share price might have been 120 or 140 or something along those lines, maybe even 150. So we're looking forward to you making that up as you deliver on your outcomes and the growth of the company and the profits coming through. And as you, I think, re-engage the company with the investment community in a positive light, focusing on the operations and what can be achieved. So we're very excited, and we understand the role that you play and the role the insurance companies play in wanting a much more efficient industry. Cars are on the road again, as we heard from the previous speaker. And with volatile weather conditions, you're not sure what they may bring in terms of requirements for repairs as well as accidents itself. So I believe it's a necessary industry. A lot of people talk about autonomous vehicles, but as you said, I think that may be many, many years away still. And we've got a long term to go with this. So congratulations again, Carl, on the appointment. Looking forward to spending some time with you and hearing how things transition under your leadership from the past and the early founders as the company professionalizes more and keeps establishing its leading dominant place in the industry. So thanks very much, Carl, for joining us today, and look forward to the future.
Thank you, Alex. I appreciate the opportunity to talk to your investors. Thank you.
Yeah, thank you very much, everyone. And again, AMA has been I'd say a bit of a roller coaster, had lots of ups and downs, a lot of press about the earlier founders, but I think we've got strong leadership with experienced executive team there and a strong board to guide it through its growth cycle. So because it's been in the news of late, we thought we would mention it. And whilst it is down, as I said, from a couple of years ago price, we have started to increase our position there. In theory, we believe it's got a lot of upside from here as they work their way through the challenges. But as we said with Pella, you know, some of these turnarounds take longer. There often needs to be a change from the sort of founder visionary to the more professional management to just make sure the execution follows the vision. That's not always the case, but eventually, with the right change and direction from the board and from shareholders actually agitating and talking, some of those changes come through. We're seeing that with another company that we've invested in that we've also known for a long time and more recently increased our position through a capital raising, which is MRM, which is the old Mermaid Marine, and we think that one is starting to show some good signs as per their recent results. So we're looking forward to more of that. One that has disappointed us in terms of the result and what we think is an overreaction by the market is ServiceStream. And it needs to be pointed out with ServiceStream that a lot of the focus is on the NBN contractual work, of which they're still doing plenty and will continue to do for a while. But people should focus on the growth in their utilities and other divisions, which has been very strong. They're a much more diversified company than people believe, and they've got a very good both board and executive team. So we think it's a buying opportunity now as the market has punished it for what it sees are a poor result. But we believe that it's a quality company, and we're actually looking forward to doing some more on that company as a potential investment. But as I said, with ACM, I just want to focus on that. I've just come out of 2 days of strategy session with the leadership team for its potential. So our vision was to sort of turn this printing and publishing organization more focused on the publishing, less on the printing, and becoming more of a capital light model focused on content and editorial and curating and digital focus. And that is happening at a rate of knots. So we were able to appraise the business at where it is today from where it was last June, and indeed from where we bought it, and very comfortable in increasing the carrying value for that investment. And we're looking forward to hopefully a bigger uplift in the future as we continue to work through that rationalization restructuring plan. So we think there's opportunity for us to expand our footprint, and that's an area for that we will reveal some plans perhaps shortly on, and we're pretty excited by the potential there. And as I said, it shows the experience within our group to be able to tackle such a project of buying well, let's call it an orphan asset from a bigger organization and transition it into a lean and more appropriate business in the digital world for today. We think we have opportunities, engaged in dialogue in in top in the future, as well as obviously dealing in the listed companies. As I say, it's disappointing that we're traveling at a discount or trading at a discount to the NTA, the underlying NTA. We're confident of that NTA being itself conservative, and hopefully that'll come through. And we're hopefully that the shares will follow accordingly. In the meantime, as I said, we'll continue to do our best to increase dividends and the yield to shareholders, and we'll continue the buyback as and when we can, as we feel it as the board that it's appropriate. So we're looking forward to 2021. Perhaps this is more of the environment where value and turnaround and opportunities along those lines are perhaps more focused on by the investment community. That's our experience over 20 or nearly 30 years of being in the investment world, and we'll continue to do that as the best as we can on behalf of everyone. So thank you very much, ladies and gentlemen. We're very happy with the first half return of 15.7%, and we look forward to continuing the journey with you. And thank you again for your support for Thorney Opportunities, ladies and gentlemen.